Hello, everyone. So this is going to be the last video of Chapter 8. We've covered all the important exercises we wanted to cover so far related to capital gains. In this last video, I'm kind of gonna, I'll say race through the final slides, just trying to pick out the details I want you guys to be aware of. So here we are sharing our screen. So starting from slide 51, we have gains and losses on foreign currency. We're not going to test you much in this course. When we exchange to a different currency, if I have $100 Canadian and I exchange it to US dollars, in which I get, 77 US dollars, and then I bring it back to Canadian, the currency exchange might change during that time. So that $100 Canadian might turn into $109 Canadian. So we are supposed to report gains and losses from changes in foreign currency exchanges. Like I said, I don't think we're going to throw a lot of Canadian and US dollars at you these are kind of introductory courses. So I think you're probably safe just sort of skipping through the next few slides. So don't worry too much about foreign currency. I am going to talk momentarily about deemed dispositions. So when we're talking about deemed dispositions, especially on items that we use personally, sometimes we might take an asset that we're using ourselves, a car or a building, a house, and we might change its use. So the house I lived in, I've moved out of it and now I'm renting the property. I've changed its use. The thing is, principal residence is protected from capital gains. Rental properties are not. So what we do is what's called a deemed disposition. I'm considering my house sold. And what that does is we recognize the change of value while it was in my personal hands, while I can protect it. And then that deemed disposition, that change in value becomes the new cost base for when it's a rental property. If I have a vehicle and I've driven it for a number of years, and now I'm putting it into my business so that my staff can make deliveries, pick up equipment, etc. When it transitions from my personal use to a business asset, we deem it disposed of. So we need to look at its fair market value on the date it transitioned. And that fair market value, that new value, becomes the business's cost base. So if the car value went up for some reason, I would pay a capital gain. I would declare a capital gain for personal use property. And then the business would use that new fair market value as its cost base to recognize any change of value in the business. So deeming rules require an item to be given a tax treatment not consistent with the actual nature of the item or event. So not consistent being, I had a personal item that is now being used for business. Its treatment has changed. The deemed disposition requires to assume a disposition has taken place when a disposition has not occurred. So I gave it to my business, but no one exchanged money. I moved out of my house, but I still own it. No transaction took place. But we have to deem a transaction took place so that we can do the math for the change in value. So situations include changes in use, or if a taxpayer severs their residency and becomes a non-resident. The principal residence exemption is only available to Canadian residents. So if I still own my house, but I break my residency and move to another country, I'll declare its deemed disposition, use the principal residence exemption while I'm a resident, and now any gain after that while I'm living abroad will be recognized as taxable income, taxable capital gains. I don't want to go through all of the different ones. I mentioned personal use to income earning use. So if fair market value exceeds cost, the UCC is limited to the old capital cost plus 1/2 of excess. We're not going to throw that complicated of an equation at you. The most important thing to know is just the fair market value is used to determine the new cost base. Again, I don't want to worry too much about change of use, but there is one thing I want to identify. Oh, special rules for principal residence. I mentioned that if I sell my house and move out of it, or if I don't sell my house, if I move out of my house and now using it as a rental property, I deem it to be sold at that time, and I can't use my principal residence after. But they do allow the principal residence to be extended as long as the rental is only for a short time and maximum 4 years. So let's say I got a job on contract and I have to move away from my home for a couple years. I can rent it out while I'm gone, as long as I intend to come back to it and resume it as my principal residence, then we don't need to declare the application of the disposition rules. So the CRA has a concession. This is slide 68. No application of partial disposition rules. Income produces is ancillary to the main use as principal residence. This is if I'm not using my whole house for rental, but I'm, renting out the basement. I can still use my principal residence for it. Um, Income earning use retains principal residence status for 4 years. So I can rent out a part of my home and still maintain it as my principal residence, or I can rent out the full home as long as I come back within 4 years and resume it as my principal residence. So they do allow that there, so there is some allowance, some concessions to have a bit of rental income from it, but it needs to still either be a house I'm living in or a house I'm returning to. I'm only gone for a short time. Change in use automobiles, capital gains deferral. There's something called an eligible small business corporation. To be an eligible small business, you have to be a Canadian controlled private corporation, basically a small Canadian business. The government wants to encourage entrepreneurship. They want to encourage the creation and development of small Canadian businesses. So when I sell my shares, if I have a Canadian controlled corporation that's a small business, I sell the shares, I can protect my capital gain. There is a qualifying disposition. But for the purpose of this slide, we're going to talk about the capital gains deferral. Sorry. If I sell my shares in a Canadian small business and then use the proceeds to buy shares in a different Canadian small business, I can defer the capital gain. So I started a business for $100. I sold it for $500,000. That's a capital gain. But I took that $500 and now I'm investing it in another Canadian controlled private corporation. They say, okay, well, since you used the proceeds to reinvest in replacement shares, then you can reduce your capital gain or at least defer your capital gain by the same percentage of proceeds. So in this example, someone sold their business, used 75% of the proceeds to buy replacement qualifying small business shares. Then the capital gain will be reduced by 75%. But the cost base for the new shares will be reduced. So what they're saying is, yes, I paid 500,000 for the new shares, but its cost base is going to be considered 500,000 less, so that when I sell the new shares, I will recognize all of the capital gain at that time. Because they're reducing my capital gain now, this practice will increase my capital gain later. So I just wanted to highlight capital gains deferrals and eligible small business corporations. There's actually a number of rules around small business corporations and how to protect yourself from taxes. But for the purposes of capital gain, we want to focus on that permitted deferral of shares of gains. So an example of this is during October 2024, John disposes of common shares in a small business corporation for $850,000. The adjusted cost base of the share was $450,000. So 850,000 minus 450,000, we have a $400,000 gain that we're working with. Within 80 days, he purchases replacement shares in a new business at a cost of 600,000. So our total capital gain is 400,000, but we're going to be able to defer a certain amount of it. And what we're going to defer is the percentage of proceeds. So we reinvested 600,000. but 850,000 is what we got for the sale. So we reinvested just over 70% of our proceeds. So we'll be able to protect that percentage of our overall capital gain, which is 282,352. So we are deferring that much capital gain, but our cost base is going to be 317,000. So that's our amount protected that we're going to subtract from our 600,000 that we invested in the shares. So now our cost base is 317. So when we sell the shares for, say, another $800,000, that becomes our new gain. We invested 600,000. We sold it for 800,000. There's another gain of 200, but we're going to be adding our deferred gain to it as well. So 482,000 becomes our new capital gain for the next business. Okay. Is there anything I want to highlight right now? Not quite on replacement. Okay. So now we're going to get to some tax planning. The biggest benefit of tax planning with capital gains is how much control a person has over the timing. When I buy a share of a corporation, let's say I buy a share of Google for $100. That was a few years ago. Now the share's price is now 350. I know that value has gone up. I know I have earned, maybe not earned, but I have recognized income. I know this share is worth more than I paid for it. The only thing is, I don't have to declare it as income until the share is sold. So there's a couple things we can do. We can hold on to our capital gains until there's a year, especially if we see one coming, where our income's going to be low. Let's say I took a paternity leave. So using EI, I'm going to go on paternity leave, and EI, I think, covers 55% of a salary for a year. So I know in 2 years, or I know next year, my income's going to be 55% of what it was. Let's say my income's going to be $30,000 less next year. So 55% of what it was. So since I have this low income year, I could choose that year to sell some of my shares that I know have capital gains, report them at 50%, and bump up my income to a level I usually have it at. So that allows me to use the timing of my income to control when I realize those capital gains, when I report them. Let's say I have shares that have a significant loss. I have some capital losses, but capital losses can only apply against capital gains. So I have some shares with some capital losses. I want to get rid of them and reinvest. So I can use that as an opportunity to sell some of my higher value shares, realize some capital gains, use some capital losses to subtract from it, and I can sort of I can execute these transactions without worrying about the tax implications because I know they net themselves off. So there's a significant amount of control related to timing of gains, utilizing losses against capital gains, and I can structure sale of capital property to take advantage of capital gains reserves. If I'm buying a business, or if I'm buying or selling a business, I'm buying or selling a large property like a building, then I know I can take a certain amount of reserve, that 20% each year, and that can help me formulate the payment structure. And I can use elective options to increase access to principal residence exemption. I know principal residence gets that +1 year, so I can use that to my advantage to duplicate that +1 as many times as I can to protect the most possible number of years. So those are the income tax planning items. That brings us to the end of the slide. Like I said, this was just the final video to highlight those couple of items. So capital gains deferral, a bit of the tax planning, and special rules for principal residences, that ability to sort of transition into rental properties either partially or part-time. Okay, thank you for your time. That brings us to the end of the lectures for Chapter 8. Reread the textbook, rewatch the videos you need to review, and I will post an announcement when the quiz opens up for Chapter 8, and you will have 2 attempts to do it. So please take your time, go through the information in the course material, and I'm sure you'll be thoroughly prepared to handle those capital gains and losses for Chapter 8. Thank you. I'll see you in the next chapter.